All right, just gonna pull it up on Instagram. Perfect. Welcome back, everyone, to our bi-weekly webinar. We're happy to have you back once again. My name is Thomas McAuley.
I'm Joe Pepe.
And today we're going to be covering quite a few different subjects. First and foremost, what me and Joe really specialize here in Lexington with is our partnership program. So our partnership program is kind of like an oasis for people in multiple different industries to be able to come and submit their deals and get them funded and put some extra money in their pocket.
Yeah, it's a beautiful asset to really have. At the end of the day, it's a referral-based program, and essentially tapping into our network and the relationships that Lexington has built over a pretty long, robust time, and finding specific institutions and lending criteria to really best suit the clients and finding the best financing available.
Yep. Absolutely.
Yeah.
Absolutely. 100%. And when it comes to our vast platform of programs, there is a very specific sector that we want to kind of cover today, where it is quite difficult typically for companies that fall within this threshold to obtain financing.
Yeah. Yep. I mean, like when it comes to this, it's going to really be categorized underneath startup funding, right?
Yep.
We're going to specifically kind of cover startup funding from businesses that are 2 years and younger, talking about businesses that are making revenue, but they're only 2 years to date. And then obviously businesses that are straight pre-revenue. We'll kind of cover the tools, the assets, the different programs that are available and how Lexington can definitely plug in and be a beneficial right off the bat.
Absolutely. So one of the main things to take into consideration as to why these companies are still classified as startups, even though they're 1.5, almost touching 2 years time in business, is because typically about 80% of all businesses that do open do end up unfortunately failing within that 2-year threshold.
Absolutely. The biggest challenge I feel like, and factuals for businesses and why they fail, is just the lack of resources and the lack of capital that they're able to present to their business to keep the doors open, right? Obviously, every business may not have crazy profit margins right off the get-go, right? So it takes time to become profitable. So having the right resources, the right tools, and especially the right funding to back your small business is essential to grow.
Absolutely. One thing that a lot of startup companies do, or just business owners in general do, is that they really maximize their personal side as much as they possibly can, because they don't really believe that there are options for financing sub 2 years.
Yeah.
So that's where working with a company like us, with a team like ours, is extremely advantageous for many reasons, but the main including the fact that we are able to find these types of companies.
Financing. And the biggest thing leveraging business products is, like Tom said, to get away from using your credit and essentially killing your credit to fund up your startup, right? At the end of the day, we want to provide value. We want to provide funding to your EIN, build business credit, and stay away from your personal debt and get everything separated completely.
Absolutely, because that separation is so key, because at the end of the day, you never really know what's going to happen in business. So when you really maximize your personal credit, it's obviously going to drop your score. And then in life, you never really know what's going to happen. So, you try and grow your business, you're using personal credit. Now, maybe you have to move houses, get a car, but you're over leveraged. And that's never really a good scenario. And one of the key things about business financing is that it does not report utilization wise at all to the personal credit.
Absolutely.
Dan Alleman, nice to see you again. Everyone, leverage Lexington Capital's lender relationships. They know the data points the lenders are looking for, and they can guide you for the lender that best fits. Couldn't really be said better. One of the amazing things about our company is that we have a very detailed and vetted processing team that will take a look at the file, really from industry, time in business, how much they deposit, average daily ending balances. We'll be able to tell where they will fall into the guidelines of each lender.
Yeah, there's definitely so many different factors that's going to qualify a small business or a startup, or even medium, any business owners looking for capital. But leveraging really our seasoned employees and our workers, right? Know our products, know our lenders like the back of our hand, where we'll be able to position and pivot towards the best success, right?
Yeah.
Obviously, right, we always want to put our best foot forward, especially for our partners, how, right, we run our partnership program.
Absolutely.
To thrive, to put our best products out there and start from the top, and then work our way down towards the best qualifications.
Absolutely. Absolutely. And that's where the varies in these programs are really advantageous. So if you're a startup company, let's say a year time in business, you're starting to pick up on revenue, you need to make that next step. You need to buy that piece of equipment. You need to overstock in a hot piece of inventory that's flying off the shelves. It's quite difficult to do that with a traditional bank. So that's where the beauty of alternative financing really comes into play.
And I feel like we can kind of dive in on the alternative side. Like Tom said, a lot of bigger banks, your typical national, regional, even credit union banks, they're just at the end of the day black and white. They want to see the numbers, they want to see the financials, and if that does not support it, the story essentially does not matter, for lack of better words. But that's the beauty thing about alternative lenders, where these lenders are really story listener, they're relationship based, and they're going to help get your foot in the door to drive to get you that business funding, put it to use and grow your business, and essentially be able to qualify for these bigger traditional lines and be bankable for your thriving business.
Absolutely. Not to mention that too, the documentation to be able to apply with these lenders are extremely light in comparison to anything from a traditional bank, as well as their requirements. So credit requirements are quite loose. Revenue requirements, excuse my hiccup, are quite loose as well. So, if you're looking for a quicker injection of capital, but you don't have quite that time in business quite yet to get for a term loan or an SBA or a line of credit, alternative financing is really where it's going to thrive.
Yeah, beautiful. As we're going through, please throw any questions, any scenarios. We're more than happy to answer them. We'll monitor everything here. But yeah, absolutely. I mean, just to kind of piggyback off how we want to, we're going to target specialize in startups for 2 years and younger. We can essentially start off with a line of credit, alternative line of credit products.
Absolutely.
Right. Beautiful thing is, even with 2 years time and less, there's alternative products that are available for the business owners that qualify. Right. Having essentially a back pocket money for revolving capital, use it as you need it, is going to be the best product out there. Any business owner should have access to.
If in the event you're not too familiar with how these lines of credits do work,
they
mirror bank lines of credits exactly. It's a pool of money that you're approved for. You're able to pull as you need and only pay back on what it is that you do pull. As you pay it back, that limit starts to replenish, and you can continue to just move the money around.
And these facilities in the alternative space, you have them for the life of the business. So 5-10 years down the road, right, you're always going to have it available. And the beautiful thing about these things, they're unsecured. So you do not need to tie in any assets, nothing towards the business at all. It's really strictly based off the revenue. What's the cash flow like? And typically credit, right? Credit will play a role as well, since credit line of facilities are more of a premium product.
Yeah, no, absolutely.
So we got a question.
What are the minimum qualifications? So for what we just went over,
the line of credit,
the line of credit specifically, a minimum of 620 credit score, and then a minimum of 6 months time in business. Got to be doing at least $100,000 annually into the business, and we can get that facility set up.
Yeah. To kind of even dive more into details on it, right? Of course, someone may hit those numbers on the surface. Industry may play a role. But it really comes down to affordability at the end of the day.
Absolutely.
Right. Especially in the alternative world, these lenders are very cash flowed, and they want to make sure you have affordability. So you may be making $20K a month in gross revenue, but if you have negative days, non-sufficient funds, you're not carrying good money, line of credit providers are going to be tough to get qualified, right? They want to see that you leave money in the bank and you can afford, God forbid, if you did take a big draw, right now you have the money to pay it back.
Absolutely. Absolutely. That all comes down to just mitigating risk realistically.
Absolutely.
At the end of the day. If you have low ending daily balances, when that monthly payment does come out, if you don't have the amount in the bank at all times to be able to cover that payment, they're not going to likely want to lend it to you, because it's very likely that they're not going to get paid or make a return on that.
And some just basic overview of this product, simple application. 4 months bank statements. From there, typically, right, we will give our internal review, as always, just to make sure it is a good fit to these specific lenders. And once it's a green light, these lenders and our team, they move very quickly. So depending on when we get it submitted, it could be a situation we have an offer same day and have access the same day. So these facilities are available literally with the click of a few buttons. They move very quick.
Yeah, which is extremely advantageous for various reasons. Piece
Yeah.
of equipment goes on sale. You need just any quick injection of capital. I mean, even if something bad happens, like roof caves in, you need to get that fixed because you can't keep your restaurant closed for weeks.
I was gonna say some industries that typically thrive on getting approved are gonna be your online stores, your retails. You're gonna have any medical practices are very good as well to cover bridges and invoices, right? Construction can be great, restaurants, right? I can keep naming them. But these are gonna be great products, right? If you got a bridge an invoice, you have a receivable coming in on a net 30, 60, 90 days, right? You can take a draw to bridge that. It's great for inventory purchases, so you can buy it in bulk and keep flipping it over and over again. Or you may need a hire or payroll, right? You got to cover payroll. These facilities are going to be great.
Absolutely. And on top of that as well, the quicker that you have the ability to pay these things off, the cheaper they're going to be. So rather than having any type of prepayment penalties, they actually incentivize swifter paying with prepayment discounts on the interest.
Yep. And just to recap, absolutely, right? This product is great for the 2 years and under, right? Because someone that's qualifying for an alternative line of credit that's 2 years time in business and younger is not going to be qualifying for the traditional option. Absolutely. It's going to be very tough.
Yep. Another program that's very good for that sub 2 year sector is equipment. So equipment financing, super essential for pretty much almost any industry, whether you're medical, trucking, construction, whatever the case may be. You don't need to have 2 years time in business. It is a little bit more credit intensive when you are that sub 2 years, but as long as you're doing revenue, we can still get it done for you.
Yeah. And the beautiful thing about us, we built out a great platform for equipment lenders. So essentially we can finance anything when it comes to equipment, right? Barber chairs, computer decks for your workplace. All right. So we can get very creative. And our team will work intensely as well, where, you may provide an invoice that's a pretty big dollar amount, which might be pretty tough to get approved. One, we could look to even split it up, find different vendors to get creative, right? So we're always here to try to support our clients and find the most creative way to get the deal done.
As well as also being able to finance multiple different pieces of equipment within one offer. So if you're looking for, a spread of ovens for a restaurant, a bunch of equipment for medical, whatever the case may be, we can get that done all in one position.
I feel like a big trend I've been seeing on my side, especially from my platform, is a lot of people are applying for gym equipment. So gym equipment, it's essentially, right, when you're looking at equipment, they want to see what the invoice holds, right? Because that's really the asset that's being held in place. That's why we can get it done with below 2 years time in business, as long as the credit checks off. But a lot of times gym equipment, they hold good value, right? That does not depreciate much. We have a big message. What is that?
Dan Allman said, another service Lexington can help you with is which banks to go to and to utilize your best credit score and file. Equifax, TransUnion, and Experian all collect different information. Why not go to the bank that pulls from the bureau that you have the best file?
We'll definitely touch on that specific product shortly as well. So I appreciate that. It's awesome.
Absolutely. So, I guess we can really just jump right into that. That program specifically is extremely, extremely flexible and advantageous for quite a few different reasons. I would say mainly the biggest one is the fact that it is pretty much almost entirely credit based. While I do take the personal credit into consideration, these are all business lines of credit and 0% interest business credit cards. So none of those utilization, none of the account itself is actually going to report on the personal side at all. So you can utilize the credit lines all the way to their full capabilities without any effect to the personal credit at all.
Great people that we're targeting here is right for even your businesses that are making revenue and 2 years and younger. Great product here, but more importantly, pre-revenue. If you're brand new, you just opened an LLC 3 days ago, right? This is going to be an essential product where we can get your business capital that's going to report directly to the EIN and build business credit right off the bat and get you ready for more traditional options, SBA loans, to get you the business credit in check as your business matures.
Absolutely. I feel like that's not something that a lot of people talk about too much, because while they're going through their daily processes in the business, and then once they do finally hit that 2 years time in business, they're looking to get something more longer term, a little bit, something that they've heard of, like SBA, for instance. Now, this program helps in the beginning, like you said, to build business credit, which is extremely essential when looking to get traditional financing. It makes it infinitely easier, and it definitely sets your business up for success right off the bat, while also giving you access to operating capital in the interim of you actually making revenue and going green on the profitability.
Yeah, and the kind of piggyback all of that, right? It's credit sensitive. So, right, we are looking at all 3 credit bureaus, and that allows us to kind of dissect of what specific banks that we can roll with, right? The beautiful thing about this product is that we have a handful of banks, 20 plus, even maybe 30 at this point, that we're continuously adding to our platform to further better find best options on the plate, from credit unions to regional and national banks. But the way this is designed, right, every bank will typically look at their own credit bureau. And it's our job, and we know exactly where to place the steal based off credit profile. And from there, it's going to give us the best chance for maximized funding.
Absolutely. And that's the tricky thing about credit is a lot of these accounts may only report to certain bureaus.
Sure.
So when you're looking at your credit report and you see, Experian is, 790, Equifax is 740, and then TransUnion is a 650. It all really depends on a lot of different factors, whether it be, new accounts, utilization, possible derogatories, late payments or collections, things of that nature. So with our experience and our knowledge of our bankers, if one bureau is specifically more impacted than another, we simply won't go to a bank that will look at a specific bureau.
Yeah, I agree. And it's, like I said, it's very credit sensitive. And the beautiful thing about this product as well, it's co-signer friendly.
Yeah.
Right. So, Mr. or Mrs. business owner does not have their credit in check. It allows you to bring in an outside party, a family member, a colleague, anyone that's willing to co-sign on your behalf. And it plays as the same role. It does not report to the co-signer's credit, and it reports to the EIN of your business. So it gives us that flexibility to open up the horizons to so many more situations and get unique on it.
Yeah, and that's not just advantageous for pre-revenue, but that could be any business owner out there at all. Maybe their credit profile, even though they do have a very good business, is just way too impacted for whatever various reasons. You can get your client an infinitely better deal than they were ever to be qualified for previously.
Yeah, I mean, just to give a scenario, you may come across, to any partners out there, someone that is very mature, 10 years in business, doing millions in revenue, but their credit is just in the 600s. Someone like that is still not going to be qualified for traditional funding, right? Banks want to see the credit in check. So something like that, a co-signer can bring them really to the next edge to give them some of the traditional options and get a taste of the cheaper products.
Yeah, absolutely. And that's why webinars like this are so important, and why we love doing them is most people don't even know that these products even exist. So it's really difficult for a lot of our partners, whether they're other financial institutions like us, financial advisors, consultants, fractional CFOs, whatever the case may be. They're always trying to find a place to land these clientele and get them the financing that they're looking for. So this is a very advantageous thing for all of you guys to be able to watch, to learn and understand that there are ways to get these types of clients funded.
Yep, absolutely. And I want to kind of back it up back towards the credit sensitive program, right? So just to kind of touch on it, what that looks like on how to get a file ready and what our process looks like to keep things nice, smooth, and efficient. It's a very simple process. All we are going to request is a credit report.
Yep.
Simply a tri-merge report. And what that is, it's just showing all 3 of the credit bureaus. One, right, if you use your own credit service monitor company, right, you can go ahead and download each bureau individually. If not, we do partner with a company that allows you to pull a nice tri-merge, a soft pull, to collect it all in one file. Basically from there, right, our team will do a nice internal review based off what the credit profile stands to do a pre-approval.
Absolutely. And that's advantageous for everyone across the board because maybe it's not the dollar amount they're quite looking for, and it saves them an inquiry for them to go and maybe potentially do this themselves, go to a bunch of different banks and really tarnish their own credit report just because they didn't really know the proper steps to take when applying at these banks. So that's a lot of great insight we get from them as well.
Yeah, it is. I mean, like the biggest thing about our traditional funding options are just the access of the bankers we have and the access of our platform, right? There's going to be so many banks out there that you may not have even heard of, right?
Yeah.
You know, it was a situation where, you know, when I started working here a few years ago and we started onboarding different banks, I'm like, who? You know what I mean?
Yeah.
I'm like, I never even heard of this bank before, but you're right, they're out there. There's a lot of different institutions that fund. So leveraging Lexington's platform and our bankers are going to give you the best results and definitely maximize funding to build our long-term relationship.
No, absolutely. And yeah, they're amazing. I mean, realistically, with that program that we didn't even touch on, any industry as well.
Sure.
Doesn't matter what kind of industry you're in, doesn't matter what state you're located in. This program can be available to you as long as the credit or the cosigner is in check. So that's another fantastic thing. I know there's a lot of industries out there, such as construction or trucking or marijuana, that are having a very difficult time
Very difficult.
obtaining financing. So this is also another very, very viable, fantastic option.
Absolutely. Absolutely. So just having a backbone, you know, knowing when your business is 2 years and younger, right, there are still a big load of different financing facilities that we can put in place. Anywhere from alternative products with the facilities based off revenue, if you have it, all the way to the pre-revenue, right? Having these different credit facilities, the 0%, and allowing us to actually give you access to pull cash from these cards as well is a big pivot point.
Yeah, and still retain that 0% interest introductory period as well. So that's awesome. And then also on the partner side of things, it's a fantastic way to monetize leads that you have that you've already, you know, obtained that you can't possibly monetize with whatever programs you may offer, whether you do strictly term loans and bank lines of credit or you do strictly alternative financing. There's always going to be a reason why a certain lead cannot get monetized. But if in the event they do have a cosigner or they do have that credit, we can help you out, help the client get financing, help you guys make some extra money, and build a good book of business together.
And just to kind of dive right into that fully, right? I definitely want to talk more about our referral program. You know, what me and Tom do, day-to-day activity to, you know, grow our brand here and to give you value here, right? You know, referral base is everything, right? It's going to be better success, better ratio, but leveraging our platform, right? Whether you're an accountant, bookkeeper, credit repair business, even a freelancer, right? You just come across businesses, you're looking for a passive income, right? Leveraging our platform, knowing all the different pivot points, all the different facilities that we can put out is going to add a big value. And right, add more verticals and revenue streams for yourself, because right, we will pay out commission splits on the back end after the client does receive the capital.
Absolutely. We have a question here. What would you suggest if you're a startup company with a partner who has majority ownership as a woman? Are you referring to like how would you go about getting financing? Because if you were looking to get financing and you're a startup with a partner, depending on the two of you who has the better credit, I would recommend sending over, you know, the credit report of the person who has the cleanest credit profile. That would be the best opportunity to get the highest dollar amount. And just a little bit more success in that.
I mean, like even if you and your partner have pretty decent credit, feel free to definitely give us a full overview. Send us both your reports. We're going to do a nice analysis and overview of pre-approval on both. We'll see which one fits better, which one's stronger. And from there, we'll be able to get our director, Appio, on the call with you guys to kind of explain the product, the process, and we'll steer towards whoever has the strongest credit on that point of view.
Absolutely. And that's one thing we didn't really touch on too far either. Typically, most business owners have 1, 2, 3, or 4 businesses set up.
Sure.
Whether they're active, whether they're generating revenue or not, that doesn't really matter in this case. So if you're looking for maximum dollar amount, we could go to other different businesses and the businesses that they own rather, and help them get funding in all of their businesses with the credit profiles at hand.
Absolutely. So I'm trying to see, Ryan, we're both great. I hope you're well as well. So partnership with private equity as well as that. So you're asking, do we partner with private equity?
Absolutely.
So biggest thing with private equity firms is huge, right? I'll touch on this, right? You may be working with a portfolio of different businesses. We can play in for multiple different ways. One, if a private equity, you may come across someone that's a startup, right? We just talked about that program, how we can plug in. or we can even talk about how we can fill the gap.
Absolutely.
Right. There's going to be a lot of situations where, equity firms are trying to raise money for an acquisition. You may have someone that's looking to acquire a $10 million business. To give an overview, an example, let's just say this business has a $5 million SBA loan in place, and the equity firm is able to raise, let's say, $3 million. Now there's that bridge, right? There's $2 million that needs to be raised. That's where depth can come in. That's where, Lexington can come in and qualify as long as the business supports it, and we can fill the gap.
Yeah, absolutely. That's the subordinated debt. Fantastic program. It really breeds the best results because a lot of those times in that scenario, 100% of the time in that scenario, if they don't meet that quota, they're not getting what they're looking for.
Absolutely.
So they have this SBA loan in place now for pretty much no reason. They just worked their tail off to get it. Not only that, but they also had to raise funds with private equity, work their tail off to get that. And it's going to fall through just because of a gap of $2 million while they're doing incredible revenue, might I add. So this is a great option, like you said, because it can fill the gap. It's also extremely, extremely fast and you can get it done within 24, 48 hours.
Yeah. I mean, like these products are revenue based. So the financing is available all up to 10 million, even more in certain situations. So as far as reaching the goals of funding facilities, right, it's something that we can definitely maximize. I feel like a lot of time, just to kind of recap on you, Ryan, is when I'm working with different private equity firms, right, there may be, they own a portfolio of businesses, maybe all in the same space, a bunch of construction businesses. Sometimes we can get unique. We can leverage one of those existing businesses to get money from there so they can fund that other, right? So we can get very creative, do roll-ups, you name it. It's more of a scenario based. It's a situation. If you have a scenario, run it by myself, Tom, the team, and we'll know right away if it's going to be a good fit for our platform.
Absolutely. And that's another fantastic thing on the partner side of thing. We've been doing this for a very long time. We're very experienced and we know our products like the back of our hand. So if you bring us even just a scenario to us, we're going to be able to look at it, review it, and kind of pick and choose and tell you which program it's going to work best for, so you can go back to your client and have some ground to stand on and have an avenue for them to walk down.
Gotcha. So in the stage of building our app where the funds with Bootstrap is almost done and developing software. Yeah, so the startup program that we touched about would definitely be essential to get you some liquid capital, right? Free money to kind of do it and get off the ground. And that's when potentially maybe a venture capitalist firm or a PE firm can come in and actually finance your whole project. But we can definitely help fill the gap early, with our credit sensitive program, whether yourself or your partner has a good credit.
Absolutely. And it's also the absolute cheapest form of financing. Typically, on average, whatever you do draw off of these credit lines, the monthly payment's only 1% to 3% of the total balance that you owe. So, for every $100,000 you have on a balance, you're only really paying $1,000 a month.
$1,000 a month, and like I said, making this minimum payment reports straight to your business credit as well. So, like I said, as your business matures, now you already have this business building up to Experian and the other bureaus. And when you're going for SBA products, your SSB score is going to be very strong.
Absolutely. And that's the great thing about the 0% interest introductory period is every dollar that you put towards that payment is going and attacking the principal immediately. So it helps you pay it off infinitely quicker, that there's no compounding interest on it quite yet.
Absolutely. Absolutely.
Absolutely. Thank you, Ryan, for your questions. I'm looking forward to working with you. We're going to have someone reach out to you extremely shortly.
Cool.
Yeah.
A little recap here.
I want to see if there's any other questions. Let me see. I think we have a question here. What are the requirements? Okay, Ross. So there's a couple different programs that we spoke about. So to start with the 0% interest introductory program, kind of that pre-revenue that we spoke about, the client has to have 680 or better credit, or a co-signer who's willing to help them with 680 or better credit. And from there, we could underwrite the entire credit profile and get a great pre-approval or pre-estimate on what dollar amount we're going to be able to see. As for the businesses that are sub 2 years time in business and that startup threshold, we really only need to see a minimum of a 500 credit score and then at least $10,000 a month going into a business checking account for at least 6 months. So the requirements are extremely light for the most part. It's extremely easy, while the credit intensive side of things typically takes about 2 weeks to really go through. The revenue based side of things is extremely quick. So that can be done within the same day to 24 hours.
Absolutely. So the best way to stay in contact with us, we'll definitely be reaching out to you, phone, text, email, whatever you prefer.
Yeah.
We're always available. Call me 10, 11 o'clock at night. Does not matter to me. Tom, same situation.
Yeah.
I'm always here to answer questions and get the ball moving.
As long as my eyes are open and my ears can hear the phone ring, it's getting answered. But we are coming to the end here. Again, Lexington Capital Holdings, we are here to help any and everybody. Our partnership program specifically, we do not charge you guys any fees. We don't have any minimum submissions. We don't have any minimum requirements. You guys have a client, you need to get them funding, come talk to us. We'll see exactly what it is we can do for you guys.
Awesome. I appreciate everyone's time.
And we pay out on renewals.
Yeah, that's true. Yes,
have a great night, guys. It was a pleasure.